All right. Good afternoon, everybody. We are here at the top of the hour, and we are going to go ahead and jump into our presentation today. I want to thank everybody for hopping on our 27T charted uh, webinar this afternoon. And really, our goal here today is to provide you with real information about how the economy is doing and be able to take what you see today and implement it in your investment strategy moving forward. So I really believe that pictures paint 1,000 words, especially when it comes to the nuanced data that it is with economic data and understanding what's going on in the economy. And really, that's what our conversation is about today. It's the state of the US economy, and we're going to be talking about key insights and trends that you can take from this presentation and utilize it again in your investment strategy. I want to go over a couple of housekeeping items first. So know that this presentation is being recorded. So if for some reason you need to step away early and take a call, or you talk to somebody in the office, they weren't able to attend, know that the recording of this presentation will go out in about 5 to 7 days following the conclusion of our conversation here today. So know that. Another thing I want to cover, this is meant to be a presentation for you. So the Q&A box is open. It's being monitored. If you have questions, you have comments, you want to make sure that you're getting everything answered, please put those into the Q&A box. And we'll also have time at the end for questions. Last but not least, an exciting thing that we're doing here at 27T is just trying to provide more opportunities for you to get real actionable information and advice through the platforms that we utilize. And so this presentation will also be housed on YouTube. Our YouTube channel is going live now officially. And so you can like and subscribe, or you not like, but subscribe to the YouTube channel. And if you aren't able to make these webinars, you will get notified of new webinars, new information that's coming out all the time. So those are the housekeeping items. Again, I want to thank you all for being on the call. I want to, really take the time here today again to talk about what's going on in the economy. We're going to cut through the noise. We're going to talk about what's actually happening. And really, we're not here to use industry language. We really want you to understand what's going on with a clear view, a clear picture. And I feel like charts are really the best way to show us. So that's why we're focused here on our charted series. So first up, how's the US economy performing? This is really a big picture graph here, a big picture image, and it's showing us how the overall economy is doing. GDP is gross domestic product, for those that aren't aware or unsure. This measures really everything we produce as a country adjusted for inflation. Really think of it as the economy's report card. Looking at the numbers that kind of all the way back to 2022, most recently Q3 of 2025, we saw growth rates of just about 4.4%. Very strong numbers. Then you'll see the green bar, the 2025 Q4 numbers have not officially come out. The Atlanta Fed, there are different cities that have different Fed offices. One of the things that the Fed does in Atlanta is try and provide a real-time forecast for GDP. And the closer you get to the announcement of the GDP number, the more in line this number is with the actual outcome. So we're getting pretty close here to getting the Q4 25 numbers. The Atlanta Fed nowcast, or what they're forecasting, is for growth to be at about 4.2% in Q4. Now, that's, again, a very positive number. And I think something that's important to understand is when we're talking about GDP, as you can see here, looking at multiple quarters over the last few years, There are good quarters, there are bad quarters. Some quarters are more robust than others. And really, if you're thinking about how does GDP, how does a gross domestic product of the US economy impact my savings in my retirement plan, it comes down to, hey, are numbers positive? Really, historically speaking, when you correlate and look at how GDP numbers impact stock market and bond market returns, you tend to see positive stock and bond market returns when you see positive GDP numbers. And so that's something that not only are we looking at the actual quarter number, but the trend number. And what we're seeing is really we're not in recessionary territory right now. And we're actually in a pretty good economic environment. And I think there's a lot of terminology that's been thrown around here in the investment world of soft landing, of different components of that. Really, what we're seeing is coming out of the COVID crisis, high inflation. Really, from an true economic standpoint, we're sitting on very stable ground today. Overall, I think that's a positive as we look forward to 2026 and what the market could hold for us. Now, moving on to the R word. And what we're showing here is data going all the way back to 1854. And that's recessions going all the way back to 1854. That terminology, that name, word, it really gets thrown around almost consistently. If you read economic news, you watch CNBC, it's always, when is the next recession coming? And I think this chart is really impactful in understanding the changing landscape that we're in today as it pertains to economic environment. Since 1854, the US has experienced 35 recessions. So that's about one every 5 years or so. But I think it's important to look at this chart and see the difference between now and, roughly 150 years ago. I know my math is off there, but just from a perspective standpoint, the bars were much more clustered together further back in history than they are today. And it's really not an accident, in my opinion. I think overall, we've gotten better about managing the economy over time, and that's showing up in this data. It's they're not that recessions disappear, but they become less frequent for sure, and in some instances, less severe. Now, why is that? Really, a couple of components. One, we understand monetary policy in this world now today better than ever. We've had a lot of experience navigating these crises to date and how to do so more effectively. I wouldn't say 100% effectively, but more effectively, especially than back in the 1800s, where there was just a true people did not understand economics and how money impacted the economy. Another component is, especially here in the US, we went from a manufacturing and farming-based economy to a more services-based economy. And I know there's a lot of people on this call here today that are in service-related businesses. Those businesses are better able to sustain negative economic environments than your manufacturing and your farming type businesses. So you're not having as extreme market cycles today as you used to. Now, why does this matter from a long-term investing standpoint? Really, I think the perspective is the most important thing here, right? Markets go up, they go down, recessions happen, but over time, the economy is growing, and really being able to stay invested through difficult times is how you're going to be successful as a retirement saver throughout your career and create that freedom and flexibility that everybody is looking for. So our next slide is looking at historical growth in the US economy and real GDP growth since 1950. This is really 75 years of US economic data in one chart. And if you remember just a couple of slides ago, GDP being our report card of the economy, this is showing where we've come over the last 75 years. That yellow line is that real growth in GDP in trillions of dollars. And the green bars show you those recession time periods, again, over the last 75 years. And so what this shows you is really, even through all the recessions we faced, the trajectory of the growth is unmistakably upward. We recently hit about $24 trillion in the most recent quarter in terms of economic growth. And really looking back just to 1950, the economy is more than 4 times larger, even after adjusting for inflation. So yes, there have been downturns. Think about 2008, most recently in 2020, 2022, the 1980s. But every single time, the economy has recovered and grown beyond its previous peak. So really, for anybody that's an investor, I always like to challenge those that say, hey, I'm at or I'm near retirement. I shouldn't be thinking in long time periods. Well, statistically speaking, if you're married and statistically speaking, if you're married and retired, there is a greater than 80% chance one of you lives 30 plus years in retirement. So I would argue that really from a planning perspective, from an investing perspective, no matter if you're just starting your career or you're nearing retirement, you really need to have that long-term perspective. Maybe there's some more intimate planning that will go on and be involved as you near retirement for unexpected expenses, for extreme downturns. But overall, there needs to be a level of long-term thinking whenever you're an investor. So I think this is a really great chart to show just that. Now, what's going on with people? What's going on with jobs? We've got a great chart here that looks at the change in what's called non-farm payrolls. This is really just a look at job growth, and it's something that impacts all of us a bit more directly than the general economy. What this chart is showing is really how many jobs the US economy adds or loses each month. Gold bars being those monthly numbers, and the green dotted line is the 3-month average that is smoothed out for volatility. Recent numbers here show a bit of a reacceleration in job growth. In January, we added just over 130,000 jobs, and the 3-month average sitting at about 73,000. Well, that's significant. It's a significant change from 2024, where we were regularly adding about 200,000 jobs a month. It shows we're still very much in a positive job environment. And really what we're seeing here, if we're looking at the data as a whole, is stability. And overall, that bodes well for the market and the economy in 2026, regardless of the noise that we're hearing today around maybe some of the new technology coming into play as it pertains to jobs specifically in this calendar year. Next, we're going to take a look at the unemployment rate. So this is probably one of the most familiar statistics for everybody. This is really how many people are out of and actively looking for jobs in the United States. As of January 2026, we're at about 4.3% unemployment rate. Now, is that good? Is that bad? Historically speaking, it's pretty good. Looking back to 1970, you can see that it ranges between 3.5% to about 15%, early parts of COVID. generally speaking, and anything below or around 5% represents healthy from a labor market standpoint. Really, if we're looking for cracks, if we're looking for concerns here, what we're looking at is direction, right? Because month to month, the exact number isn't going to say, hey, we've gone into a new territory. But if we start seeing trends as things start to move upward, that's where things can get concerning from a labor market perspective. We've ticked up a little bit over the past year, but not dramatic. I think this is something that, from our standpoint, we're watching closely. We don't think that it's a negative, but it would be if you're thinking red, green, yellow, or red, yellow, green, green being good, red being bad, yellow being watch, if you will. We're going to be sitting in that yellow territory here with the unemployment rate. So the number itself is telling us that finding a job isn't easy necessarily, but given if you're looking for the right job, you have the right credentials, it's achievable for what we'd call a qualified worker. So again, today, I think overall we're in a healthier, more stable labor market, especially compared to just a couple of years ago. But looking at the trends, that's something that we want to make sure that we keep a close eye on to see what direction we go over the next year or so. This is a chart that I think is really interesting. So apologize for nerding out here, but this is looking at quits versus hire. So we're going to be a little bit more nuanced than the unemployment rate. And we're going to show you two key dynamics here. That's how many people voluntarily quit their job in that gold line, and how many people are being hired in that green line. The latest data that we have is from December of 2025, where we had 3.2 million quits and 5.29 million hires. Really, because that green line is above the gold line, right? The higher line is above the quits line. Really, that's healthy and continues to be healthy. So more opportunities are being created than lost to voluntary departures. The gap compared to 2021, 2022 is vastly different. Really, that's that time period, that great resignation time period, where quits were surging and people felt very confident that no matter what they did, they were going to find a job and find a higher, better paying job. We're out of that cycle now. And I think for folks that are in the hiring process today, it's likely easier to plan from a workforce standpoint of, hey, we're going to need this many people, we're expecting this many quits. Overall, if you think about that from an economics perspective and from a business perspective, that's a positive. From an individual standpoint, people, if we're trying to group people together as a whole, really, I think that people are being more cautious about leaving current positions, which suggests a little bit less confidence in the job market, considerably less confidence than a few years ago. So overall, again, very stable, very positive from a market and economic perspective. It's an interesting standpoint for those that may be thinking about looking for a new job or are on the hunt. Next up, we'll have retail sales. So consumer spending, if you're not familiar with it, this represents over 70% of the US economy. So when consumers spend, the economy grows. When it pulls back, that's where we tend to see problems as it pertains to growth. In 2025, retail sales came in at a decrease of about 2 basis points. And that's just looking at month over month numbers. The 3-month average, it came in at a positive 13 basis points, which shows positive but very modest growth. I think it's important, though, to look and see all of these months because you see it is a very volatile number. It's not something that is consistent. And so you do see these large jumps if you look back to May of 2025 versus March of 2025. Pretty significant change just in a matter of months. And so there is a component of more so paying attention to the trend in this specific month. Currently, what that means is, really consumers are still spending for the most part, but certainly considering more or spending more cautiously than they were before. It's, really not a dramatic pullback, but it's also not aggressively spending like we saw coming out of COVID. So from our perspective, what does that mean as a retirement investor and a retirement saver? Again, we're seeing very solid footing from an economic standpoint overall, which bodes well for the stock market. But again, I think this is another aspect in the red, yellow, green component. We're sitting here at yellow. We want to make sure that this doesn't take a dramatic turn here, and that we continue to see a cycle of growth. I also think it's important that negative growth is not always a bad thing, and slightly positive growth is not always a bad thing. Sometimes the ability to have these bars get a shrink in size, again, allows businesses better opportunity to plan and forecast than when things are jumping all over the map. So could end up actually being a tailwind. Right now, I'd say it's just, we're just kind of in a holding period. Next up, we're going to take a look at the federal funds rate and the FOMC projection. And unless you're a market nerd, you probably don't have any idea what that means, and that's okay. Really, what the federal funds rate is the interest rate that influences all other rates, mortgages, cars, credit cards, what you earn on your savings. So it's not directly impacted, but it influences that. And so it's a very important thing to be watching from an economic standpoint. As of February 2026, that number sits at about 3.64%. The green dotted line is the FOMC, where the Federal Reserve expects it to go over the next couple of years. So looking at the end of 2028, seeing a slight decrease to about 3.1%. Just a quick review of how we got here. So really, the Fed started aggressively raising rates in 2022 and 2023 to fight inflation coming out of COVID, where during the crisis, they brought it to almost zero and took it to over 5% in a matter of months. Pretty dramatic change from 0 to 5%. You can see that very clearly here on the chart. But it at least now it appears to have worked. It maybe took longer than people would have hoped, but inflation has cooled significantly. We'll talk a little bit more about inflation here on the coming slides. But now we're seeing a gradual lowering of rates back to what would be deemed normal. Now, because most of us here have lived professional lives through the 2010s and in a very low interest rate environment, I don't think that return to normal will be happening soon. I really think that we will be sitting with a bit more higher interest rates than what we were used to just prior to the COVID crisis. But I don't necessarily think that's a bad thing. I actually think that having more normalized rates creates more incentive for businesses across the country to invest in their business. It helps, where credit is not overly tight, but it's not overly risky. It kind of hits that Goldilocks spot. And so that's why I think this projection is great. Really what it means practically is borrowing rates come down a little bit, mortgage rates get a little bit more affordable, things become slightly cheaper. It does impact cash, so high yield savings rates will gradually decline a little bit. And that overall bodes well for the stock and bond market valuation component. But another aspect here is as we're sitting here today, these are the expectations. We are going to be going through a leadership transition with the Fed here in the month of May. So there are different priorities that may take place, and this chart may be stale here in just a few months. But judging by reading the tea leaves, I think it's appropriate as we project out for the next year or so that we're on a pretty consistent trend from an interest rate perspective. And we may see some rhetoric change as it pertains to interest rates, but I think it's going to be harder to get things done from a Fed perspective than what some might be anticipating with the change coming in May. So, interesting thing that we're going to be paying attention to right now. I would say this overall is in that Goldilocks territory. It's a good interest rate environment for business and business success. All right. Wage growth. So who wants to make more money? Looking here at our chart, we're looking at January 2026 average hourly earnings increased about 41 basis points. That's from the previous month and looking at a 3-month average of 29 basis points. If you annualize the number that we're seeing here, we're looking at about 4% year over year wage growth from the US economy as a whole. Now, is 4% good? Is really a question I would be asking myself if I was unfamiliar with this number. And really, that depends on inflation. So with inflation sitting at about 2.7%, real wage growth, that's wages minus inflation, we're looking at a real increase of about 1.3%. And that means workers are actually gaining purchasing power and not just trying to keep pace with the continued increased cost and rising prices. Overall, steady wage growth creates space in household budgets for things like saving more, for investing, for sending kids to daycare. It creates flexibility in the American household budget. So overall, this is a positive thing. I think, quite frankly, I consider myself somebody with boots on the ground. I'm talking to people every single day as it pertains to their saving, their investing, what's going on in their financial life. This number certainly stands out to me because there is a dichotomy between really what people are feeling and what's happening in the real economy. And so that's where taking the time, being on this call, understanding the numbers behind what's happening, I think is really going to give you an advantage as a saver and investor to be able to make strategic decisions with real time data. So I think that segues nicely into our feelings about the economy. So this is more objective. It's not something that can be tracked through numbers. And so this is the University of Michigan's Consumer Sentiment Index, and it tracks Americans' attitude about finances, the broader economy. Really, it's a survey, and then they assign a number to it to try and say, are people feeling good or feeling bad about the economy? As of December of 2025, we're looking at a reading of 52.9. Probably doesn't mean anything to you, but to put that in perspective, typically this index ranges from about 60 to 100 during good times. So think late 90s, mid 2000s, pre 2008. It actually got all the way to above 90. Right now, we're currently at one of the lowest levels outside of a major recession. I'll let that sink in for a second. I think what's interesting is a paradox here. We've got, by many objective measures, if we look at employment, GDP, wages, the economy itself isn't bad. It's actually on some pretty solid footing. Yet overall, people are feeling terrible about it. Now, why is that? Well, I mean, ask yourself, how are you feeling about the economy? Do you feel great? Do you have questions? Do you have concerns? I think that's a simple place to start. As I constantly think about markets and the economy and how this is impacting real people, there's a couple of things that come to mind for me. Lingering frustration over inflation, I think, is going to be the number one cause here of this sentiment. I think when you add on top of that uncertainty with the advent of artificial intelligence, with the, for lack of a better term, a political climate, both here in the United States and outside, right? The negative media that surrounds that and the narratives there, there's a real psychological effect that's impacting people overall. And part of it's money, part of it's just feel in general. And I think it's important to know that if you're feeling angsty about the economy, quite frankly, you're with the majority, right? But why does it matter? Well, really, financial decisions that are driven by emotion rather than facts often backfire. And so doing things like stopping contributions because you're feeling pessimistic about the economy, or being too conservative from your investment allocation perspective, that can really have a negative impact on your ability to create that financial freedom that you're looking for. So I think, again, tying back to taking the time to understand what's actually happening, and then marrying that with understanding not just your own feelings, but what other people might be feeling, and maybe realizing that that isn't necessarily matching up, is going to create a positive opportunity for you. And so I think overall, just kind of just keep with my message is keep with it, keep being positive. I certainly am a believer in markets and the ability for them to grow over time, as we've gone through a lot of the history and details through these charts here today. But overall, I think things are moving in the right direction. Now, we talked a little bit about inflation earlier. Let's dive into the data so you can think about it objectively as well. As of January 30th, 2026, headline inflation was about 2.5% year over year. Core inflation, which is going to exclude food and energy prices, which tend to be a bit more volatile than your everyday basket of goods, was at about 2.4%. So overall, pretty decent reading. If we look at 2021 and 2022, that's where those inflation spikes happened. And we were, believe it or not, all the way over 9%. And that's the highest in the last 40 years, which again, I think ties back to that sentiment standpoint. We haven't had a shock like this in over 40 years, and it's really hard to understand objectively when you're in it. So where we are today, we've come a long ways from that 9% down to about 2.5% overall, right in line with the Fed's target of 2% inflation. We're very close. But here's the key. Inflation numbers mean one thing, but what does that mean in real life? Just because inflation slows doesn't mean prices went back down. So if eggs cost $3 in 2020 and jumped to $6 in 2022, well, because inflation's at 2.5%, not higher, that may be $6.15 here in 2026 versus $6.30. So prices are still high. They're just not going up at the rate that they went up coming out of the COVID crisis. And I think overall, this is why people are still feeling frustrated. The prices aren't going down, they're just slowing how fast they're going up. And so, technically, from an economic perspective, the environment has changed and is really positive now. But from a personal standpoint, you're still comparing to prices 5 years ago, and it's not helpful from a sentiment standpoint. And overall, I think we're back to a more normal sort of inflationary environment. I think we're in the right space from a market and investment perspective. So the positives are, hey, any of your contributions aren't being eroded by 8% inflation today, but higher prices are still going to impact you. They're going to impact the people that work for you. And so budgets can be tight. It can create frustration. I think all of that's a good time just to make sure as you're working through things, as you're planning out your year, that that's taken into consideration. Overall, from an economic and investing standpoint, though, I just want to tie it back and tie a note on this component. We're sitting in a good spot. And then another look here at inflation. So if you are paying attention to the Federal Reserve, what they're doing with interest rates, I do want to show you this chart because we're looking at what's called the PCE, or the personal consumption expenditures. It's just simply another inflation measure, but this is what the Federal Reserve prefers to look at over the CPI, the number we were looking at previously. Basically, because it captures a broader range of spending and adjusts for how people change their spending habits when prices rise, and also um, seasonality. So overall, as of November 25, headline core PCE was at about 2.8, slightly higher again than the Fed target of 2%, a little bit higher than CPI, but not dramatic. And it just ties back into that story that yes, inflation has improved dramatically. But we have been through a time of periodic high inflation. And I think that's going to provide a lasting psychological impact on many people, not just investors and savers, but the general public overall. So I think this just reinforces stay diversified, invest, because it will outpace inflation. Lastly, this is our last topic here for today, or slide here for today, and we're going to look at what's called a leading economic indicator. So what are we looking at that can tell us about the future? And that's looking at trends in producer price index. So CPI, PCE, those measure what you as a consumer pays. The PPI measures what producers pay. Think manufacturers, wholesalers, businesses, what they're paying for their inputs, right? If you're making a tire, what you're paying for the raw rubber before you form it into a physical tire. As of December 2025, headline PPI was at 3%, and core PPI was at 3.3%. That's year over year changes. Really, why does that matter? PPI is that leading economic indicator. So as costs rise, eventually we do see those costs tend to end up in what consumers are paying. So when prices stabilize, consumer prices follow. Really, PPI has cooled from 10 or 11% in 2022 to 3% roughly. Again, suggesting that those inflation pressures have considerably changed over time. Now, that 3% number is still slightly higher than the CPI reading of 2.7%, meaning there's still some cost pressure in the system, but the trend is in the right direction. Costs are rising at a much more manageable pace than it was, especially just 2 years ago. And what you'll see is, is we're looking at the PPI being at 10 or 11% in 2022 and inflation being at 9%. That's about, let's use some simple math here, about a 2% difference in inflation versus PPI. Well, now that we're at a 3% PPI, you're looking at a 1 to 2% inflation rate overall, or a narrowing rather of that inflation at 2.7%. to the 3% PPI. What that means is it helps businesses overall be more profitable when they're not absorbing as many costs as they were previously dealing with high inflation type of environment. Now, I still think there's a difference between the two because the data is showing that businesses are taking on a lot of the tariff expenses and not passing those on to the consumers because of the inflation environment we've come out of. But other than that, margins look good, profits look good from an earnings perspective. So I think this number reads right in line with that. So really, that is what I had prepared for us today. I'm going to have some closing remarks here, but I wanted to let everybody know we've got time for questions here at the end. We want to make sure that you've got time to get your questions answered. So pop in the Q&A box and I'll gladly answer those questions. But just summarizing the key themes, really, the US economy is resilient but cautious, right? We're growing, unemployment's relatively low, and inflation has cooled dramatically. But we are seeing some shifts in the job market and really some pessimistic sentiment. But overall, things are really in a positive perspective. From a retirement planning angle, I think this environment really creates opportunity for you as an investor and a saver. And that's where these uncertain times are where you earn those market-like returns, in my opinion. Staying disciplined matters more than anything. Being consistent with your contributions, taking that long-term approach, while also planning for realities, right? Planning for everyday expenses, planning for unknown expenses, planning if you're nearing retirement, how do I structure my allocation to make sure I don't have to put off retirement if a huge market correction happens the month before I want to retire. These are all important components that come into planning for your financial future. So what I want to leave you with is focus on what you can control, right? You can control your understanding of the economy, but you can't control GDP. You can't control interest rates. You can't control inflation, but you can control what you save, how you invest, and your view of what your time horizon is. The data we showed you is that the economy overall looks pretty good. And outside of some extraordinary disruptions, I think we're set up for a positive year. And I think that's a good thing. So I want to thank you all for taking the time, and we are going to hop into some questions here. So again, if you want to ask questions, please pop them in the Q&A box. I've got that pulled up here on my screen and I can answer those. A good question that just popped in, I'm going to answer this right off the bat. Is consumer debt at all-time highs, and how will this affect the economy going forward? So the short answer to that question is yes. Consumer debt is at an all-time high. It actually continues to rise. What's interesting is not only has debt risen, but the actual difference in what people's assets versus their liabilities, right? Their investments versus their debt has also continued to grow. So if you think of the individual as a business and you're looking at a balance sheet, the health of the consumer's balance sheet is healthier today than it actually has ever been. So there are numbers that are going to come out in the economy that create this concern. Hey, we're nearing another consumer debt crisis, and what I found is oftentimes it's folks that are fighting previous battles while not looking at the bigger picture. So I think overall, yes, debt has risen, but it's also risen in conjunction with assets that overall says the economy is still in a very healthy perspective or a healthy place. Now, what are we looking at to see if that would change? Specifically, we're looking at, are people starting to default on that debt? Is that rising? Not just necessarily in a 1 month time period, but over a longer term trajectory. Are there, loan is the loan environment getting too loose, right? Are people getting access to debt that they shouldn't have? And that would be a concern as we look at the economy. But tying a bow on that, yes, it's high, but no, I don't think that it's going to be a negative from a market perspective as of right now. And really focus if we're focused on markets in 2026, it's certainly not going to be a concern from a market perspective as we move through this calendar year. The next question, this is a hot topic around AI. So, how is AI going to impact the potential for jobs loss and uh, efficiency in the economy? So, I think this is something that's on everybody's mind today. I would be surprised if everybody on this call hasn't had some sort of exposure to AI, artificial intelligence at all. Um, Fascinating technology. I think it's something that my hot take on that really is I think it's going to enhance the ability for us to be more human and be able to connect more on an individual level than ever before. So I'm actually on the, if you consider the positive side, I think AI is going to be positive for the overall economy and for everyday people like ourselves as it pertains to work. Um, Now, how is that going to impact jobs? How is that going to impact the economy? I'm not going to pretend like I can project out 5 or 10 years into the future, but I'm very confident in what the next 12 months looks like, right? If we're looking at the calendar year 2026, what is AI going to do to our livelihood? Um, my opinion on this is we're going to continue to see AI get better. And what's going to happen is efficiencies are going to come into the business world, which overall benefits you as a saver, as an investor, right? As businesses get more profitable and you're owning a piece of that business, you in turn get the benefits of that. So I think overall this year, one, efficiencies are going to help businesses overall because the AI tech is getting better every single day. Two, if you think back to our very first slide on GDP and you see those 4% numbers, which overall are very high positive numbers for an economy the size of the United States, a lot of that comes from infrastructure spending on AI, data centers, the whole nine. And so that spending in 2026 is only increasing. So the largest spenders are only increasing their spend in 2026, which from a market perspective, again, is a positive. Now, the flip side of that is, hey, where's all the spending going? What if it doesn't work out? Well, I think one thing that's important to understand is um, what often gets thrown around a lot right now is the dot-com bubble versus today. I've wrote about it, I've thought about it a lot, and I think that one thing that's important to note, what's important to understand, is in the dot-com bubble, valuations exploded, and you were paying 100 times revenue for pets.com. Whereas today, the Microsofts of the world are spending, but they're spending with free cash flow, very little debt. And that's a very big difference in taking on high debt and not having a real product. Um, Overall, I think the Mag 7, Magnificent Seven, the seven largest stocks that drove the market for the last 3 or 4 years, NVIDIA, Microsoft, Google. I know I'm going to miss a few here. I'm not going to bore you with all of the names, but what's happening, there is a transition in the way these companies are being viewed because they are going from an asset light business, right? Mostly a software as a service business to an asset heavy business. And so, especially through the first part of this year, what we've been seeing is a bit of a re-rating of those stocks, right? So they're going being viewed as this asset light model with high profit margins to condensed profit margins and being more asset heavy. That doesn't mean there'll be worse businesses. They just may not maintain the growth multiple that the market has been putting on to this point. So AI, I think, is going to continue to be an important theme in the markets moving forward. I think as we condense our timeline and think about 2026 and how to be successful as an investor in 2026, I think that AI will be a tailwind for growth in your portfolio in 2026. I'll give folks just another minute to pop in any more questions in the Q&A box. I want to thank everyone for the questions that they've popped in here. For those that might have missed our intro, I do want to let everybody know again that this has been recorded for us. So I will be sending out the recorded version of this presentation about 5 to 7 days after this, after it goes through editing and review for you. And it will be hosted on our new YouTube channel. So I want to make sure that you can get access to education that is timely and relevant for you, regardless of what's going on in the world. So make sure that when you go on and you view the recording of this webinar, that you click the subscribe button, and that way you can be notified of all future videos that we have coming down the pike throughout the year. I'm really excited about everything we have coming out. And I think that, like content like we've gone through today, we're going to be providing you with real information that you can use in your saving and investing life. We're going to try and make it simple and easy, digestible, and approachable for everybody. So it doesn't look like we've had any additional questions come in. I want to thank everybody so much for being on the call today. I really enjoy this particular content, our 27T charted series. I think it's just such a great way to condense and simplify what's going on in the economy, how it impacts you, most importantly, as a retirement investor, and what to do about it. So hopefully you've got some good takeaways from our presentation today. Thank you all for being on this call, and keep an eye out for the email here coming shortly that will include a link to this recording, and it will also include a link to my calendar if you want to talk about anything specific to you, your investment allocation, your financial plan. Schedule time with me. It's an inclusive part of your retirement plan, so that's what I'm here for. I want to thank everybody again for being on this call today, and I hope to talk to you soon. Thank you.